Welcome to Stock Talks with Akash. Follow this channel to create a money mindset. Hey, hi there. Welcome back to my channel. And today in this video, we'll be learning all about price to sales ratio. So let's get started. So what is price to sales ratio? It's a type of valuation ratio. Value ratio. So today we'll be using the 5W and 1H framework to analyze the price to sales ratio, what it is, and how can we use it to best of our abilities. So first of all, let me tell you what is price to sales. Price divided by sales. Price is nothing but current market price, and it is sales per share. How can you calculate this? Current market price would be, you can take it from any website, and sales you can take TTM sales data divided by per share, so it will be number of which number of shares. This is current market price, so you can calculate price to sales very easily with this formula. Or if this denominator comes into the numerator, what happens is current market price into number of divided by sales trailing 12 months. What it is? It is nothing but market cap market capitalization divided by sales trailing 12 months. So this is very easiest formula to calculate the price to sales. So what does price to sales signifies? Price to sales signifies how much an investor is willing to pay for 1 rupee sale generated by the. So interpretation is, let's say price to sales comes out to be 2. Okay. So investor is willing to pay 2 times of the sales to acquire 1 share. Similarly, let's say if the price to sales comes out to be 4, so an investor is ready to pay 4 rupees to acquire 1 share of the company which has gained 1 rupee sale. Okay, very easy explanation. Now, how do we interpret it? So just to let you know, we have done these 2 things. Okay, now why do we use price to sales ratio? Okay, okay. Now let's see, why do we use price to sales? So there are many reasons. We'll focus on 3. First is that it is resilient to accounting gimmicks. Accounting gimmicks. It could be also used if the company is loss making, and it could be also used in cyclical stocks. In cyclical, what happens is in some months there are great earnings, in some months There are not so much because of its raw materials cost fluctuates. However, it has been noticed generally that the sales more or less remains the same in cyclical. So price to sales could give you an accurate picture, or you must also look at that too. Please note it's not a standalone parameter. Price to sales, not a standalone. You should always use it in conjunction with the other ratios. Okay, it's not a standalone parameter while selecting a stock. Now let's see the theoretical interpretation of price to sales. So generally speaking, of course, the lower the better. We wanted to pay as lower price compared to sales as we may. Okay, lower the better. For cyclical and technical stocks, less than zero point 0.5, 0.75 is considered to be as very good. Zero point 0.5 to 1.5 is considered to be good. Greater than zero point 0.5, greater than 1.5, sorry, is considered to be a bit expensive. And greater than 3 is considered to be risky. This is we are talking about for non-cyclical and technical stocks. For cyclical stocks, example, Tata Steel or any steel stocks and car auto stocks are comes under cyclical. So cyclical stocks, in this, if it is zero point 0.4, then it is a very good pick. Zero point 0.4 to zero point 0.8, it's a fair value, and greater than zero point 0.8, it's very expensive. It's considered to be as expensive. Now, apart from this, of course, how will you interpret it? Interpret it is by comparing by itself or with industry average. It is similar to the ones that we have done prior, price to earnings and price to book. We usually compare price to sales by itself, that how much it is as compared to its previous. We can see trailing 12 months. And of course, we can also analyze it with the industry average. If it is lower than industry average, then it's, of course, it says cheap as compared to the industry. If it is greater than industry average, then it is expensive as compared to its peers in the industry. So that is how we interpret it. Now let's take an live example. So let me take you to an example. Let's go over here directly, and we'll be taking an example of trend, and let's see if it is expensive or if it is cheap. So we'll land on this page. We'll be comparing on the basis of 1 year time frame. Okay. Now let's go to valuations, and we need price to sales. So let's see how much it is currently. It is trading at 11.3 price to sales. Its median is 15.1. So as compared to the median, it is currently cheap. Okay, as compared to the median, of course, it is low. If it would be 15 or higher, then it would be expensive. So currently it is cheap, and we are taking an year of 1 year. It could be different from for 5 years, maybe. Let's see for 5 years. So median price to sales is 10 for 5 years time frame. It is currently expensive. But however, I usually take for 1 year always. Okay. Now let's compare this with 11.3 with the industry average. So for industry average, I would be referring to investing.com. Over here, if you could see price to sales, it is 14.08 for this industry. Okay. And we have 11.3. So currently it says cheap, right? So that is how we analyze it. So now let's take a parting thought. Uh, I would really recommend to do not use price to sales in isolation because there are limitations in this ratio. Okay, the first, there are many, however, I am covering only three for now. The first one is it ignores profitability. Sometimes what happens is sales could be constantly increasing. However, there for each sale, the company is incurring losses. For example, Zomato or Swiggy, for that matter. The second point is sometimes what happens is the company inflates its revenue by lowering its profit margin. So what happens is for some time the company's profit margin has been reduced, thereby its item or the product is more attractive to the general public and thereby the revenue increase. However, it is not an actual revenue increase, it is just because of an event that the company has decreased its profit margin. And the last one is, of course, it ignores the debt levels. If the company is generating revenue on a huge debt that it has taken from a bank, then it could be very risky at a time, right? So that's all for this video. I hope you like it. Thank you for watching. Stay tuned to this channel for more insight content. Thank you guys.
Disclaimer:
Bye.
the information provided is for educational and informational purposes only and should not be considered financial or investment advice. I am not a SEBI registered investment advisor or research analyst. Investing in stocks involves risk, including the potential loss of principal. Always conduct your own research and consult with a qualified financial advisor before making any investment decision. Past performance is not an indicative of future results, and all investment carry inherent uncertainties. The author and associated parties are not responsible for any financial losses resulting from the decision based on this information. This channel does not promote any form of guaranteed returns or insider tips. Always invest responsibly. Thank you.